Well, we have Scott Krone with us here tonight. Scott, I really appreciate you being with us and being part of the Mastermind Network here. So, with that, I'm going to definitely send everybody to your website because you cover a lot of ground. Everything from multifamily investing to storage units to, I mean, you even have an architecture degree. I mean, you have a lot going on. I mean, it's I got to admit, you've crammed a lot in your lifetime here already. I don't know where you're going to go from here, but man alive, there's a lot of masters of architecture, bachelor of history, and then a length of awards that I've lost count on here. So I appreciate you being a part of this here today. And head over to codamg.com. That's codamg.com. I'll make sure to have that link in the show notes so you can go to reimastermind.net for all of Scott's links, because I'll include where you can find him on a couple of socials there as well. But I really appreciate your time here tonight, Scott.
Thanks for having me, Jack. I appreciate the opportunity. And
no, go ahead.
I was just going to say, perhaps if I'm facing the other direction, I'll look a little bit older.
So with all of that, we're going to focus, because you have such a wide range of experience. We're going to try to focus on multifamily, especially storage units here tonight. And so this is going to be a great exercise in comparing both of those type of strategies, because I think there is some synergy there. But I do have to ask, what attracts you with all of your experience to real estate investing?
Well, as you pointed out, I did begin in architecture. And for me, that's the creative portion of, there's two elements to the creativity. One is the design, and then also the other one's creating the deal structure. And to me, that's where I get the most satisfaction of seeing a vision come to fruition. That's something I've always enjoyed doing, is being able to build something and seeing, the finished product. So for me, that's one of the most tangible rewards with being in real estate and doing both the design and the build and the development, is seeing what the vision coming to fruition.
Sure. So it sounds like you also, in the process now, you primarily work on multifamily investing and storage units, but you also have a management company as well. Is that correct?
It is correct. Well, we've stopped doing multifamily. I sold off the portfolio in about 17 and started just solely focusing on self-storage. And we created one-stop self-storage in response to that as well.
What caused you to make that decision?
Well, we had a major REIT, Fortune, S&P 100 company managing our assets. And we were seeing, not very good velocity in terms of lease up, but expenses were increasing over 40%, including marketing. And their conversion rate was just like around 22%, just horrible. And so it was costing us more. It was not being as run the way that they said they were going to run it. And we felt that we could just, literally outperform them on our own assets. And so we started our own management company. And sure enough, that's what we've been doing, is we've been outperforming them pretty significantly.
So you're focused on storage units now. What caused you, for the most part, to decide on that niche outside of, there's a lot less of, obviously, that can go wrong there.
It is multifamily without toilets. So yes, I was in the middle of the night regarding, why my plumbing is overflowing because I stuffed, 3 socks down the toilet or something like that, right? So when it was in the last recession, the major recession of 08, 09, that I had a client ask me to start investigating distressed self-storage. And I really couldn't find it. So I really began just studying the business model and understanding what it goes. And over the last few years, we've gone back and studied self-storage over the last major recessions, beginning in 79. And then we were looking at the internet bubble and the housing market crash. And each of those major recessions in self-storage continually outperforms any other asset class in real estate. And so for us, the fact that it's predictability and you can model it, and it's a lot easier to manage than other asset classes.
Yeah, it's funny you say that, because I've never thought of that. Up until tonight, I have never heard anybody refer to it, anything there in that niche, as distressed self-storage. I've never heard of such a thing.
It's very hard to find.
Yeah, it's got to be very hard to find. So these self-storage units that you're buying, are they typically mom and pop type outfits, or how are you locating or sourcing these deals?
Of all the deals that we've done, we've only bought 2 existing facilities. The rest of them we're creating self-storage. So
Oh,
we
really?
buy an existing building and then we convert it into self-storage. So we are working on some land development ones, but the last 2 that we bought, one was to expand it and the other one was to improve the management. So that was a first for us, where there was really no design or build. It was a very little CapEx, replacing a fence, replacing signage, putting a motorized gate on it, those sorts of things. Otherwise, the bulk of the work that we're doing is conversions.
Yeah, so you're converting and retrofitting existing buildings. Are you finding certain buildings that are better suited for that? I know, for example, in our world, Kmart, like there's a lot of Kmart empty buildings right now. Is it
That's a
those type
perfect
of things?
building for it. The challenge with those is that whether or not the local municipalities will allow the building to be rezoned into self-storage. Some do, some don't. So, but that's a perfect box. A big square box with a loading ramp and multiple ways to get into the building is a great box for us. But we have different criteria. So one is we want to see what the local competition is. What our square foot per capita is. Excuse me. Then we also want to look at what the shape of the box is. How easy is it to get into it? Does it have enough ceiling height? The construction technique. Are there elevators? What size elevators? Those sorts of things. So we take all those things into consideration. We've done as high as a 9-story building, and we've done as 1-story buildings.
So yeah, I've just noticed that more and more seeing I just sure see a lot of storage units going up in my part of the world, and a lot of what you're referring to, people doing these conversions, and you'd think eventually you just kind of run out of opportunity, but it doesn't seem to end.
Well, right now the American public only 10% of the population utilizes self-storage. And so overall, it's not a vastly served population. So, but there's pockets where there's oversaturation. So that's where we look at those demographic studies to make sure that we're going into an area that's underserved.
Sure. So in comparison to your experience with multifamily investing and now the self-storage, how do running the numbers differ to make sure that it's a viable investment?
Well, I'd say the first thing is that, it was very hard to get feasibility study numbers on what future demand is within multifamily. But we can see that immediately within self-storage. So that's the first thing. So if we're comparing the two, I have a lot better understanding of what the demand is going to be. And then I can also pull up what is the market rate for those lockers. So I can see is their market underserved or overserved in terms of the pricing. So we will have a comparison on that. And then when we look at the expense ratios, multifamily is around 50-55% expense ratios. Depending on the building, self-storage can be anywhere from 25 to 35%. 35 would be very high.
Yeah, like you said, like we said when we kicked off, there isn't a lot that can actually go wrong there, right? Do you have any that are like climate controlled, or is it all?
With the exception of the ones that we just bought, all the ones that we have built are all climate controlled. So they're all considered Class A. You drive up, you're enclosed, you're in the building, and you can unload it and take a cart and roll your stuff to the locker.
So when you first got into this, did it surprise you that people would pay to store their excess stuff like this?
It didn't surprise me. What was surprising me was how big some of these facilities are. So the ones that we're building are between 70 and 100,000 square feet. And so, those are, if you think about, in my mind, self-storage would be like out in the country where you drive down a dirt road and then you turn into a gravel road and you have some drive-up lockers. So the 2 that we bought are like that, but now they're in urban settings where they're in downtown. So ours are literally 3 blocks from baseball fields, and they're surrounded by multifamily.
So as you've been getting into storage investing like this, to give us an example of a mistake that you made, that you learned, something that you learned from that somebody else could make that same mistake, that give them a little advice on how to avoid it.
Well, I don't think it's necessarily just within self-storage. I think it's overall within real estate, especially now. I think now is a very critical time in the marketplace, in the market cycle, not to overpay for something, because you make your money on the purchase, not on the disposition, and overpaying can set back any project. It doesn't matter if it's multifamily, self-storage, whatever it may be. And I'm seeing apartments that are trading at like 3.5, 4 caps, and it's just like, where's your potential upside? And that's one of the reasons why I sold my multifamily, was because I was like, the caps can't get any better, and so I did. And I was wrong, but I'd rather be on the front side of that bell curve than on the backside, because the backside's pretty fast drop off.
Yeah, no, I completely agree. And the last couple of years, we've been really dealing with a pretty strong and hot market. Things get on the market and they were selling really quickly. And there's nothing worse than overpaying for a property and then it not performing, because you don't want to have to throw in extra money to just maintain.
Absolutely.
You, in chatting with your assistant, they mentioned that you have 3 mind-blowing facts about self-storage.
Well, I think we touched base on a little bit. One, it is a predictable model, so we can go and study the demographics. The area that we're looking for, when people say like Class A multifamily, they are looking at, let's just say, the cream of the crop neighborhood of your local city, right? The best neighborhoods. But self-storage, it's a 1 to 3 mile radius. I mean, that's how tight the location is that we're studying. So it doesn't really matter if there's 20 other facilities in the city. We're looking at a 3 mile radius. And so it's a lot more focused than I was originally aware of. And we can very, very specifically pull the demographics. So we will know how many square feet of lockers per square foot. We will know the demographics, the population, the median household income, what the unit price is for a 10 by 10, a 5 by 10, a 5 by 5. We will have all this data going into it beforehand. So for me, that is dramatically different. The second is just, if I compare the two, the investment is like 10%. So my first project that I worked on was a 400 unit development that we sold for $100 million. And, the cost was, a high percentage of that. In self-storage, 400 lockers, I mean, we just bought 343 for like $2.5 million. And so it's like a lot smaller investment. But then within that, I have a lot more flexibility. If we're doing with a multifamily, I have a very specific unit count. I can't change that up. But in self-storage, I can remove a wall. I can make things change a lot simpler and easier. And so that's the second one. And the third one, it's really a retail business as well. A lot of people think of it as a real estate play, and it is, but it's also a retail business. And so you have to treat it as both. And so that's what makes it another unique thing, comparing the differences between the two, is it is a retail business.
Well, when you say retail business, what are you selling outside of the storage?
Well, I mean, we sell locks, we sell boxes, we sell wrap, but the churn rate. So,
Sure.
Some people will stay like 3 months, but some people might stay only 6 months. So you're constantly leasing it, but the difference is that I don't have to go through the massive eviction process that you have in multifamily, especially like here in Chicago, where it's so onerous to be an owner of a multifamily comparing to being the tenant. I mean, this whole moratorium on rent. I don't know how a lot of multifamily owners survive because of the fact that if they weren't collecting rents, how do you pay your mortgage? How do you pay your taxes? How do you keep the lights on? We don't have that stress within self-storage, because if someone stops paying, we send them a notice. If they ignore the notice, we lock their unit, we give them another notice, and then eventually we say goodbye and we're done.
Sure. Well, one of the things that you said that was interesting there too is that you're dealing with a 3 mile radius. Is that typically as far as somebody will drive for self-storage?
Yes. So the reason why we say 3 miles is about 15 or 20 minutes. So like if you're in like Chicago, New York, LA, that might be like 1 block.
Yeah. I was going to say that doesn't work around here. 15 to 20 minutes is 15, 20 miles in my
That's the difference. If you're out in the country, that's a little bit different radius.
Yeah, that's interesting. So it's more of a time constraint versus a distance constraint.
Correct. It's how much of a hassle is it to get to it?
Sure. So do you focus on certain parts of the country then?
We're focusing on the Midwest. We're looking at secondary markets, which are underserved. If you look at the demographics as the country overall, the East Coast, Florida, Texas, and then California and the West Coast are very saturated. So like the national average of square feet per locker is around 7, but in some of those markets we're seeing it, approaching 13, and they're still building. And, to me, that's just like way too much risk.
Sure. So, I got to ask you, because I'm just downright curious. If somebody has left, or you've sent them a couple notices, what do you do with those lockers? Is it exactly like you see on television regarding auctioning those off? And how much gold do you actually find in those units?
I've never found any gold. So first of all, no. Second of all, it's nothing like this shows. I mean, it's sort of like the home improvement shows where they totally renovate a house in a week or a month, and then you have clients come to you and say, well, why can't you do this? It's like drywall takes so long to dry. Tile takes so long to set. There's there's only so much you can do to rush these things. But I have a friend in Massachusetts, and he gave notice to someone, and he didn't hear from him, and he kept calling him. He finally called him. And he goes, hey, you haven't been paying your rent. You haven't been here in a year, 6 months. He goes, well, I got a DUI. It's too far out in the country. I can't get out there. You can have what's in there. And he goes, well, what's in there? And he goes, a BMW model 2002. And he's like, you can have it. Like, that's the best I've ever heard. But, most of the time, people are storing files, or they're storing, things that they think they might hold on later on. And usually doesn't have that much value to somebody else. It's certainly valuable to the person who stored it. But a lot of times it's just, we clean it out and moving on. I mean, there are auctions, but they only yield like $300, $400, $500, just to cover the back rent.
So it's probably best to, for the most part, just clear it out, get access to it again, and
exactly. I'd rather get the unit rented up.
I think I've seen some places that there's actually some guys are just kind of provided as a service. They'll come and clean it out for free if they can keep the stuff.
Yeah, absolutely.
Yeah. So that's really interesting. So tell us, like, your biggest project to date. Like, give us the breakdown of how those numbers looked, and or what maybe that's what you're working on right now.
It is. It's we found a facility down in Louisville, Kentucky. The first thing we had to do is we had to learn how the locals say it, so that they don't think they were not from there, but in Louisville. And it's a 145,000 square foot building, and we're going to put about 60% of it is self-storage, and the other 40% is flex warehouse space. And so it's actually in 4 buildings, and we're dividing half the building in 4 flex tenants, and then the other 60% will be for self-storage.
So define flex tenant so people understand what that is.
It's like warehouse, but it's like nicer warehouse. So it's like, could be office. And so, for instance, we have a company that makes safety rappelling equipment in there. So they assemble it and then they sell it. We have a guy who restores damaged furniture, and he has an artist in there. And then we have a carpenter who uses it as his workshop. So we have just a wide range of tenants. And so it could be any one of those tenants. It could be an office, it could be, storage space for a company, it could be, just however they need to use it.
So this mixed use model, is this the first time you've done that?
No, we have another building that's a flex warehouse space. And in that one, we have a mechanic, we have baseball fields, we have an indoor field, we have a gym in there, we have golf training, simulation, we have physical therapy for kids, occupational therapy for children, and just a wide range of tenants.
So what's the benefit there where you have the mixed use like that plus the storage units in the same area? Have you found that it somehow balances each other out, or?
Well, the building was too big to make it all self-storage. So we were looking at how we could best utilize the building. And so that's where we tapped into our other experience and said, hey, if we do this and this, we can create enough revenue to make it worthwhile for us to do this.
Oh, I see. So with these type of projects then, and you're kind of splitting the use of these facilities, have you also taken the time to figure out that what else is underserved in that area, like what other businesses would fit, or do you just do you have to draw people, is what I'm asking? Do you have to draw tenants to that facility?
We will, but I mean, there's never enough. I mean, here's the interesting thing. In Louisville, coffee shops can serve alcohol. They can serve whiskey and beer. And so there's a boutique hotel across the street. So we could have like a speakeasy saloon, in one of the spaces. And so, but we have a broker to help us with those in terms of what is the market. So we've analyzed that product as well as the self-storage to make sure that there's a marketplace for that.
Sure. So is this pretty much all of these investments then? Have they all been self-funded by you and your partners, or do you have any kind of syndications or
we have
associated
investor
with
pools in each one of our projects. And so, we have a group of people that we go out to and, learn their level of interest in the projects that we're doing.
Well, if somebody was interested in what you're doing, would they find some information, or is it not open to in that way?
If they go onto our website, www.coda.com, you can see some of the past projects that we've done, and then there's a place for someone to learn more information.
So, with everything here, you're doing your self-storage, and it sounds like you're completely out of the multifamily, but now you're getting into commercial rental spaces as well. With all of this opportunity that continues to present itself, have you found it hard to find that next opportunity? It sounds like you and your team are pretty imaginative when it comes to finding a deal somewhere.
Well, there's an abundance of empty buildings, so that's not the challenge. The challenge is finding an empty building that meets the other criteria. And so, we look at zoning, we look at population, we look at the building structure, we look at purchase price, all those different things. So, we're keeping ourselves busy. Let's put it that way. And I think self-storage does really well in recessionary markets and thrives. And so I actually deemed it recessionary resistant. A lot of people call it recessionary proof. I don't think there's anything that's proof in real estate, but I think that the trends so that it resists recessions better than other classes. And so, I'm feeling that there's a recession coming in the next, 12 to 18 months. And so we're setting up our business for that.
Well, with that in mind, what have you been doing differently if you believe that there's a recession? I think we all kind of see something coming. You can't have something without record high gas prices and record high inflation and we just can't continue with all of this without seeing something burst here soon.
Yeah, so that's a great question. So some of the things that we've been doing is, making sure we have our debt structure good in place. And then the second thing is also we've been just buying other assets, like the one we just purchased. I mean, that one was the market rents were 30% below market. So what we're going to do is just go in and raising the rents. And so, that's our improvement to the property. But when we stress test it, we looked at 5 different models in terms of stress testing it. And each one of them came back to how it's existing performing is like the worst stress test because it's so underneath the market. And so that's one of the reasons why we purchased that asset.
Yeah. So that's interesting. A stress test. I don't think I've had anybody mention that before. So can you explain how you stress test these properties? You said you had 5 different models. Is this software or something that you've developed regarding the stress test?
Well, my mentor always talked about think of life in best case, worst case, and what will most likely happen. And can you live with worst case, and can you live with what most likely will happen? So for us, the stress test is playing with the occupancy, playing with the rental rates, just moving the different factors around to see how much, if we say that there's going to be a 10% drop in vacancy, or if the rental rates are going to get cut 5 or 10, 15%, whatever it may be. And so in this model, because the rental rates were 30% below and the facility is 90% occupied, it's been 90% occupied for the past 15 years. Mm-hmm. There's plenty of demand in the facility. And so no matter how much we stressed it, 15, 20%, the existing rental rates were 30% below. So it was like, even if we were, playing with the vacancy, but had higher rental rates, it was still doing better than what it was currently doing now. And so that's where we just determined that the existing facility is, under the worst case scenarios. We can play with the rental rates, but keep the occupancy, and it's still performing about the same.
Yeah, that's an actual tip there that I think everybody should take note of. Stress testing your property and the financials and make sure that under that stress, it still performs. That's a really important tip. I appreciate that, Scott.
My pleasure. I mean, the 2 major things that, everybody knows that banks look at debt coverage ratio, but they're also looking at debt yield. And so those are the stress tests impact both of them. And so that way you can look at what the debt yield is.
Sure. Okay. Well, we're kind of running out of time, but before I let you go, I really wanted to drive everybody one more time to your website, the codamg.com. Again, it's codamg.com. And but before I let you go, Scott, is there a question or a thought you wish we should have covered here today?
Well, I think we touched on it briefly in the sense of where the market is going. I mean, you mentioned that gas prices are high and inflation is starting to rise. But I'm preparing for a presentation, and I was looking back to the last Great Recession, which was in '79, and gas prices back then were 85 cents a gallon. Now, if you put that in today's dollars, it's $2.35. But here in Chicago, it's like $5 a gallon. And we're looking at unemployment exactly the same, 6 million people. We're looking at the big telltale sign, though, was if we looked at the amount of debt compared to the gross domestic product, it was in 1979, it was like 35%, and now we're at 133%. And so it's like we've been printing so much money to keep us from going into a recession. It's now going to be catching up with us, and the Fed's hands are tied in terms of what they can do. All they can do is raise the interest rates, which is then going to slow down real estate. In terms of what people can afford, what people can buy, and those sorts of things. So we've cut our domestic fuel production, and if we go after manufacturing, is a lot lower than it was in 1979. And then if we look at retail's been hurting for 2 years now. So the only lifeboat that's really keeping the economy going is real estate. So if we begin attacking the real estate sector by hitting the inflation, interest rates, which they have to do, it's going to cause a recessionary pressure.
Yeah, and this past week we already saw signs of that. They tapped on the brakes a little bit. It's only a quarter point, but it's gonna go up from there.
Absolutely.
So, well, I really appreciate your time, Scott. Again, it's codamg.com, and you're welcome back anytime. I hope you'll take me up on that.
Absolutely. Just let me know. I'm happy to join.